the best of Money Matters. Market View on Money FM 89.3.
You're listening to Money FM 89.3, and it's now time for Market View, where we take a look at how the Singapore stock market closed for the day, the biggest movers, sectors, and companies to watch to help you better position your portfolios. I'm Alexandra Parada. The SDI closed up at 0.7% at 3,876 points. OCBC reported a 5% decline in Q1 profit to 1.88 billion Sing dollars, driven by lower net interest income and higher operating expenses. Despite this, the earnings still exceeded analysts' expectations, beating the consensus forecast of $1.86 billion. Meanwhile, ST Engineering reported a 14% rise in revenue and a 9% increase in net profit, signaling resilience despite global headwinds. Looking at global developments, India's benchmark Nifty 50 slid 1.4% amid rising tensions with Pakistan, with the government reporting the neutralization of Pakistani drone and missile attacks. The U.S. and UK have also reached a breakthrough trade deal, with President Trump and Prime Minister Starmer touting the agreement as a historic step. And with the U.S.-China trade talks scheduled for this weekend, the U.S. is reportedly aiming to reduce tariffs on Chinese goods by 60%. Now, for more market moves and views, joining us today is Benjamin Goh, Head of Research and Investor Education at SIAS. Hi, Benjamin. Welcome back to the show.
Hi, Alex. Thanks for having me.
Thank you for joining us. Okay, the SEI opened at 3,858 points today. So what do you think drove market sentiment this morning? Any major movements being led by specific sectors?
Well, not particularly. There wasn't any kind of broad-based narrative, but as you pointed out just now, you've got trade talks that's scheduled to happen over the weekend between the US and China, so that's all good news. So the market expects them to have some kind of, guidelines about how they want to structure their trade deal going forward. So any kind of certainty on that end is obviously welcomed by all markets. If you look at today's STI movement, you have got ST Engineering performing really strongly at 1.6% up. That's really because of their really solid order book, and I believe we're going to be talking about that later. Financials were good. Three local banks all did well. OCBC was up about 0.5%, but of course leading the charge was DBS up at 1.44%. So the overall performance for the STI today is very much in line with US overnight markets as well as what's happening in European markets right now. Most markets are in the green. Looks like we are having a risk-on a weekend, which is quite welcome after the last few days of last few weeks of uncertainty.
Now, looking at OCBC now, they reported a Q1 net profit of 1.88 billion Sing dollars, which is down 5% year on year, mainly due to lower net interest income and even higher expenses. But interestingly, this still beat Bloomberg's consensus estimate of 1.86 billion Sing dollars. Was this a case of expectations being too low, or did OCBC actually manage to pull off a better than expected quarter?
Well, it's a bit of a mixed bag. So I guess the market was expecting certain parts of OCBC to be performing, and they didn't. Got a net interest margin, right, which you have already noted. So it was down unexpectedly by about 11 basis points quarter to quarter to about, currently is about 2.04%. The problem here is that the decline was much larger than expected and was certainly larger than its competitors. But that said, this decline in the net interest margin still falls within management's full year guidance of about 2% for the full year. But of course, they have got a lot less flexibility now that it's already reached 2.04%. Now, if you look at the asset under management, AUM, for OCBC, that was up 2% quarter and quarter. Both asset quality as well as the loan book looks good. Company has already stated that there are no issues with non-performing loans, and we can see that from the numbers. So very, quite clearly, the credit quality of the borrowers still holding up. I think the main takeaway is that the competition, in terms of the local loan market, might be heating up. So, and, the narrative could be that potential borrowers are holding back on big ticket purchases like furniture, like, vehicles and so forth. So, because of the current economic uncertainty. So with OCBC, the decline in NIM, net interest margin, it could be just because, they need to adjust their loan pricing as a result of competition.
At the same time, its non-interest income actually rose 10%, and non-performing loans improved slightly to 0.9%. Do you think this shift towards more fee and trading income as a healthy diversification, or should investors still be cautious?
Well, certainly diversification is good. So if you look at the bank's business model, right, so you've got net interest income, that's one pillar that drives revenue. The other is fees as well as the AUM part of the business. So if you look at net interest income, it's really driven by the bank's cost of funding, how much interest it can charge to borrowers, and how big a loan book it is. Now, if you focus on the bank's, how much interest it can charge to borrowers, interest rates are not really driven by any particular one bank. It's actually driven by the macro environment as well as central bank policy. In Singapore, the central bank, SIAS, doesn't actually manage interest rates. They actually manage exchange rates. So that's a further complication in how the interest rate environment is structured in Singapore. So that is that the bottom line is the banks cannot really manage their, interest rates, so they have to basically just price it according to what the market is willing to accept. So from that angle, it's actually a little bit difficult for the bank to manage. Now, if you look at the other two types of businesses the bank has, so you've got the fees as well as the AUM, asset under management type of business, that is certainly, any bank certainly has got a lot more control over that because it comes down to the types of products you're selling, the customer service that that you have, the goodwill that you've generated with your clients, and so forth. And certainly in OCBC's case, the wealth management fees are up 18% year on year, so that's amazing, right? So not a bad thing to have more revenue generated from fees. So it provides a little bit more stability and less volatility compared to the interest rate cycle.
I see. Now switching to ST Engineering now, the group posted an 8% rise in Q1 revenue to 2.9 billion Sing dollars and locked in a staggering 4.4 billion Sing dollars in contract wins, while defense and public security surged 18%. How significant is this growth, especially in light of rising geopolitical tensions?
Well, if you look at the numbers for ST Engineering, the aerospace revenue was about flat year on year at $1.15 billion. As you pointed out, the defense and public security revenue was up staggering 18%, and now it stands at $1.32 billion. So there is a change in the revenue mix. So traditionally, aerospace is kind of the big, generator for ST Engineering, but right now it looks as though it's, defense and public spending. So it's the largest contributor to ST Engineering's revenue right now. So if you think about it, certainly the world has changed since Trump came to, started his second term. The global security situation is a lot more uncertain, and, it used to be that the U.S. will come in as the big brother, the policeman to kind of govern the neighborhood. But as you can see, you've got local, I would say, conflicts like the Middle East, what's happening with Israel, what's happening with India, Pakistan, so on and so forth. And really it looks as though, our big brother is no longer around. So, in hindsight, right, it is not really surprising to see the surge in the defense and public security spending. Now, that's it. Business goes in cycles, right? So right now, governments are spending more on defense simply because of the uncertain security environment. But things will change. So this surge is probably not going to be sustainable in the long run. At some point, it's going to plateau, and governments will spend on something else as things become more peaceful. So it's good for now, but I think it is going to change over time.
Now, still in Asia, India's benchmark Nifty 50 slid 1.4% after the government said it neutralized Pakistani drone and even missile attacks. Could this mark the start of a sustained geopolitical volatility priced into Indian assets?
Well, it could be. So long as the saber rattling continues, we should expect high volatility for Indian assets. So as you have already noted, the news feed has Pakistan shooting down at least 2 Indian Air Force planes, and that was corroborated by an unnamed U.S. security source. So obviously tensions are rising with both sides, and now we have got more recent news that they are launching drone and artillery attacks on each other. So this is to be expected since this is only day 3. So how this normally works is that we're going to have all this going on for the first few days, and after the kinetic phase of the crisis settles down, the financial markets should stabilize. Now, if you look at what's been happening with Indian equities, the slide 1.4% wasn't that bad, actually, because nowadays, plus minus 2% up, down in financial markets, kind of a given what's been happening with the tariff wars, the news feeds, so on and so forth. So sliding now 1.4%, I expected it to be more, but I think, the crisis is kind of localized and constrained to the Indian continent for the time being.
But with hostilities between India and Pakistan escalating overnight, are we actually looking at a short-term market overreaction or the early stages of a broader risk-off move in South Asia?
Well, truth be told, Asian markets have not reacted much, actually. So not really seeing any kind of broad-based sell-off. The overall narrative driving markets is still the current tariff war and, whether or not countries can get their trade agreements in with the U.S. So I think the overall nonchalance of financial markets is really due to the fact that, this is not the first time Pakistan and India has come to blows. I mean, we've seen it before, right? So what usually happens is that after going a few rounds, cooler heads will prevail. And right now, the market impact is really just very localized. It's constrained to India. I would also say Pakistan, but Pakistan doesn't have much of a financial market, but it's really India. So it's very localized impact. Now, that said, when it comes to geopolitics and saber rattling, there's always a chance of miscalculation, right? So after all, both countries have got nuclear weapons. But right now, the market is pricing in a scenario where tensions would die down and things will go back to normal after a while. So no broad-based risk off, nothing like that.
Now, moving over to the U.S. and the U.K., President Donald Trump and British Prime Minister Starmer have hailed a new breakthrough trade deal that lowers U.K. tariffs but keeps the U.S.'s 10% baseline in place. Do you think this deal is skewed more towards U.S. exporters, and what sectors, if any, will benefit the most on either side?
Well, I think it's too early to tell who got a better deal. Obviously, Donald Trump will say he got a better deal. If you look at what's been published, there is still going to be a 10% baseline U.S. tariff on the U.K. with exemptions for the steel and aluminium imports into the U.S. The U.K. also has to open up its market to U.S. beef and other farm products. But in return, the UK got a win for its automotive industry. Instead of facing a 27.5% tariff, it now only needs to pay 10%. But obviously, if you think about it, 10% is a big discount from 27.5%, but 10% is still very high compared to zero. Also, the current agreement looks like it excludes pharmaceuticals and digital services, which are big sectors in both countries. Presumably, those are still being negotiated. So I would say that it's not so much a breakthrough trade deal. I think, it's kind of like a baseline trade agreement, where the two countries can still build on. So it's very much a work in progress. No way does it constitute any kind of a comprehensive trade deal.
But do you think this kind of uneven trade agreement could actually set a precedent for future U.S. deals? And what does this mean for global trade fairness and investor confidence in cross-border policy stability?
Well, the Trump administration had already, stated that the 10% baseline tariff is going to apply to all countries regardless of how good a friend each country is to the U.S. So even in Singapore's case, where we essentially have got zero import tariffs, we also face a 10% tariff for goods going into the U.S. Now, I would also say that fairness is probably not the right term to use because we are talking about an agreement between sovereign states. And of course, sovereign states can do whatever they want, right? So, but if you look at it from the perspective of investors and consumers, I think what is more important is really the uncertainty created over how the U.S. can unilaterally change the treaties he had already previously signed, right? So we had all these trade agreements and all that, and the U.S. just ripped it off. So it's not that things have changed, it's the way things have changed, right? All this uncertainty. So if we can't trust the U.S. to do this, then how can we trust the U.S. to do something else, they say, right? So this overall reduction in trust really has got a tangible negative impact on cross-border stability. And we are seeing that in the financial markets. We are seeing that in all those localized conflicts that are flaring up now.
And Benjamin, with the U.S. and China set to begin trade talks this weekend, the U.S. is reportedly aiming to reduce tariffs below 60%. Do you think this could be a significant turning point for market sentiment, or should we remain cautious?
I think it's best to remain cautious. Probably, good to resist that FOMO feeling until more concrete facts come out. So unlike the UK, China can actually wait it out. So they are the second largest economy in the world. They have a very sophisticated internal economy, domestic economy. Yes, they do export a larger percentage of their GDP out compared to the US, but they can actually survive without having too much of an export industry. Now, for the Chinese, obviously, they will want a binding agreement that works for them. And, they don't want to rush something out just to please the journalists and the financial markets. So I think time is on their side. So whatever news flow that we, see over the weekend, that's probably going to be the tip of the iceberg. Probably not a great idea to run out and, sell the HDB flat and buy, stocks anytime soon. So the current narrative of ongoing supply chain disruption, high inflation, slower growth in the US, etc., that is still the main scenario going forward.
And before we let you go, anything else you'll be looking at in the days ahead?
Yes, Monday is a public holiday, so I always love long weekends. Apart from that, business is still ongoing. We have got Walmart, Alibaba, Cisco Systems, Sea Limited releasing their earnings next week. Those are the companies I'm looking forward to because they represent a nice segment of the U.S. economy. So you've got consumer spending, you've got tech, you've got gaming, so on and so forth. So we had financials being reported in the U.S. already, some of the big tech companies as well. So I like to see the other side of the U.S. economy.
Well, thank you so much for joining me today, Benjamin.
Thank you so much for having me.
That was Benjamin Goh, Head of Research and Investor Education at SIAS. This has been Market View on Money FM 89.3.
Before acting on the information on Money FM, please consider if it's suitable for your own investment objectives, financial situation, and risk tolerance. To listen to more great interviews, download our podcasts at audio.sg or download the audio app. That's AWEDIO, audio at the App Store and Google Play.